the Philippines has seen quite a dramatic shift in political stability in the past few months. This is due to the recent detention of former President Rodrigo Duterte, who is currently in The Hague facing charges related to his war on drugs. Despite the instability that the current president, Bongbong Marcos, sees, the Philippine economy is actually doing very well. How so? Just take a look at the recent quarterly growth of the Philippines. In the first quarter of 2025, the Philippines grew by over 5.4%. Some may say that this is very slow as compared to previous quarters, such as in the first quarter of 2024, where the Philippine economy grew by over 5.9%, or the first quarter of 2023, which saw 6.4%. But comparing economic growth from previous time periods doesn't really paint the entire picture of current environments. What you need to compare the Philippines to is with other countries. For instance, within the major economies of Southeast Asia, the Philippines was actually the second fastest growing economy, just behind Vietnam. That's a good sign that the Philippine economy is doing really well. But the first quarter aside, the entire year of 2024 was also a year for the Philippines in leading Southeast Asia. For 2024, the Philippines posted economic growth rates of over 5.7%, which again puts it the second fastest amongst the big economies of the region. If we were to compare the Philippines among major growing economies, they actually surpassed China for the year, and is far above other fast-growing economies as well, such as Bangladesh, Brazil, Turkey, and so on. The story is again applied if we look at the projections for 2025. For the year, the International Monetary Fund, according to its data mapper, is seeing a 5.5% growth rate for the Philippines. At this rate, the Philippines isn't going to be the second fastest in the region. It's actually going to be the fastest. It will be above Vietnam's 5.2% growth rate, China's 4%, and nearly above every single Asian economy, except for a few such as India. The IMF's forecasts point to an even brighter picture. The data that the IMF publishes in its website shows that the Philippines' GDP growth rate to 2030 will be among the highest globally, averaging around 6 to 6.3% per year until the end of the decade. As a result, the nominal GDP of the Philippines will grow from $461 billion in 2024 to over $757 billion by 2030. That's a huge increase in just 6 years. But what's even more surprising about this forecast is that they will become the second largest economy in the entire Southeast Asian region, above Vietnam, Thailand, Malaysia, and Singapore, and just behind Indonesia. All of these projections and economic growth are happening in no other than Bongbong Marcos's tenure, which is going to end by 2028. So, why is this the case? Why is the Philippines, despite all the political gloom that we are seeing, is actually poised to grow extraordinarily out in the future? Well, let's take a look at some policies and the overall economic engines of the Philippines. Let's first start with Bongbong Marcos. President Marcos has accomplished several feats that have helped the Philippine economy grow seamlessly, some of which have even been praised. One of these reforms is when Marcos signed the Create More policy, which aims to enhance the Philippines' tax incentives regime to be more globally competitive, investment-friendly, and predictable. The law reduces the corporate income tax rate for registered business enterprises, RBEs, from 25% to 20%, and introduces enhanced deductions, such as a 100% additional deduction for power expenses, to help businesses manage high energy costs. The effects so far can't be quantified as of yet due to the recency of the law. But according to a report published by the Board of Investments in late May 2025, they have approved over 3.5 trillion pesos under the Marcos administration. This is from July 2022 to April 2025. The total investments include record-breaking annual figures of 1.26 trillion pesos in 2023 and 1.62 trillion pesos in 2024. Certainly, one of the reasons for these massive investments can be attributed to lower taxes. The Create More Act, after all, has not just lowered taxes, but also extends tax perks for strategic investments up to 27 years and institutionalizes provisions allowing up to 50% of employees in RBEs to work from home while still maintaining their incentives. These investments would then help drive current and future economic growth. On top of Create More, the Marcos administration has also continued to push for infrastructure development in the Philippines, a momentum that started with previous administrations. According to the interactive database from the Department of Economy, Planning and Redevelopment, they now count 207 flagship projects worth 10 trillion Philippine pesos under its Build Better More umbrella, spanning railways, airports, dams, and telecom backbones. According to the budget for 2025 published by the Department of Budget and Management of the Philippines, they are expected to allocate over 1 trillion pesos in public works, but total infrastructure allocated to the Build Better More program would amount to a massive 1.6 trillion pesos. These infrastructure projects would enable the Philippines to significantly enhance its economic landscape by improving connectivity, reducing transportation costs, and fostering regional development. The entire budget of the Philippines, although massive and may draw some scrutiny by observers, is actually very healthy. This is because if we look at the fiscal balance of the Philippines to GDP, which measures how much the government is either spending beyond its means or keeping its finances in check relative to the size of the economy, the numbers actually look reasonable. For 2025, the fiscal balance to GDP is actually going down to a deficit of 5.2% from a deficit of 5.6% in 2024. Further projections also show that they are going to continue to go down until 2028. In other words, even though the Marcos administration is pushing bigger budgets and more spending, they aren't actually going into reckless debt. Instead, they are doing it in a way that is measured and strategic, ensuring that expenditures are aligned with economic growth and rising revenues. Beyond the budget and policies, it is also good to know that the Philippines is now seeing low inflation. The Bangko Sentral ng Pilipinas inflation fight pushed headline CPI from an 8% peak in 2022 down to 1 to 2% in 2025, well inside its 2 to 4% target band. With price stability re-established, there is a big chance that the central bank would lower interest rates by late 2025. With lower interest rates, this would ensure more affordable loans for businesses and households, a critical catalyst for boosting investment and consumer spending. From an overall perspective of the Philippine economy, there are signs beyond the Marcos administration. For one, the Philippine economy continues to thrive due to electronic exports, remittances, and its famous BPO sector. The electronics exports is forecasted to grow in 2025 after 2 years of contraction, which may suggest that global demand is finally rebounding, especially from key markets like the United States and China. The Semiconductor and Electronics Industries in the Philippines Foundation, Incorporated, SEEP, expects investments to come into the sector, but it would take time to translate into the manufacture of exports. The president of SEP, Dan Latica, once told reporters that it takes a year or two to get the investment into production mode, so you won't be able to see it right away. But the other thing is, you're fueling the growth engine with this investment, which will eventually generate the supply chain. On top of electronics, the Philippine remittances have continued to grow month after month, year after year. This is good for the Philippines because the US dollar has been consistently strong compared to the Philippine peso, which means that every dollar sent home by overseas Filipinos is worth more in local currency. This exchange rate advantage gives households more purchasing power, enabling them to afford food, education, healthcare, and even property investments. Then thirdly, and finally, the BPO sector of the Philippines isn't just expected to grow minimally, but extraordinary. Some reports say that the BPO sector could potentially exceed over $40 billion in earnings for the year, which can add anywhere from 80,000 to 100,000 in new hires. Although there are some caveats to the BPO sector, one of which, according to a director of the Contact Center Association of the Philippines, indicates that the BPO sector may see slower growth projections due to technological disruptions that are shifting industry dynamics, mentioning in particular advancement in artificial intelligence. The director said that the AI is there, the technology is there, it's becoming better. But now, companies are more cautious about delving into these types of new technologies. So, as one can see, the Philippine economy is indeed heading into stronger growth into the future, as forecasted by the International Monetary Fund. But it is important to acknowledge that these are mere projections. Anything can change. For one, we are seeing the rise of Donald Trump 2.0, which imposes tariffs on many economies globally. If Trump continues to push tariffs out, these projections may potentially change for the worse. But anyway, do let us know what you think. Thanks for watching.